the budget isn't just about announcements, it's about where the money flows, because that's where investors make returns. So in this video, we are cutting the noise and focusing only on capex in budget 2026 and the sectors and stocks it directly supports. The government has framed budget 2026 around 3 kartavyas or 3 core duties. The first is accelerating economic growth by improving productivity, competitiveness and resilience in a volatile global market. The second focuses on people, building skills and capacity so citizens actively participate in growth. And the third is Sabka Saath, Sabka Vikas, ensuring growth reaches all regions and sectors. For investors, the key signal lies in capital expenditure, so let's start there. The central government's total public capital expenditure has increased from 11.11 lakh crore in FY26 to 12.20 lakh crore in FY27, a 9.8% year-on-year increase. This is pure capex, meaning money spent on creating long-term assets like roads, railways, power infrastructure, defense equipment, and digital systems. This increase matters because it sets the base for execution visibility across multiple sectors. Infrastructure remains the largest and most consistent beneficiary. Now within this, road, transport and highways allocation has increased to 3.10 lakh crore. It supports expressways, economic corridors, urban connectivity and logistics-heavy routes. What's important is this is not a one-time spike but consistent allocating growth. L&T, NBCC, HG Infra Engineering benefit directly because a significant portion of its order book comes from roads, metros, ports and urban infrastructure funded by central and state capex. As long as road allocation continues to grow at this pace, order inflows remain predictable rather than cyclical. Now let's move to railways, which forms the second major infrastructure pillar, with the government allocating 2.77 lakh crore to the sector. This spending supports freight corridor expansion, station redevelopment, signaling upgrades and rolling stock procurement. In addition, the budget identifies a network of high-speed rail corridors including Mumbai-Pune, Pune-Hyderabad, Hyderabad-Bangalore, Hyderabad-Chennai, Chennai-Bangalore, Delhi-Varanasi and Varanasi-Siliguri, which require sustained capital investment over multiple years. Now, rail spending is long cycle in nature, meaning the benefits accrue steadily over several years rather than appearing within a single quarter. Railway execution companies such as RVNL and IRCON benefit from this sustained allocation because freight corridor projects and network expansion provide multi-year visibility, while IRFC gains from the increased and predictable funding requirements through long-term railway capex financing. On the manufacturing side, higher rail spending leads to steady demand for wagons and coaches. This supports companies like Titagarh Rail Systems and Jupiter Wagons. In logistics, better rail connectivity improves freight movement efficiency, which benefits Container Corporation of India through higher volumes and better asset utilization. Now let's move to the defense sector, which receives an allocation of 5.94 lakh crore rupees. Defense spending is capital heavy and long-term in nature, covering aircraft, ships, electronics and weapon systems. This allocation supports defense manufacturers directly. Hindustan Aeronautics benefits from aircraft manufacturing and maintenance activity. Bharat Electronics benefits from radar, communication and electronic warfare systems. Specialized defense electronic suppliers such as Data Patterns and Paris Defense Technology benefit as defense projects increasingly rely on complex electronic systems rather than only mechanical platforms. Hindustan Aeronautics and Bharat Dynamics benefit from higher electronic avionics and guidance content across aircraft and missile platforms. MTAR Technologies benefits from precision components used in missiles, space and propulsion systems, while Solar Industries India benefits from rising demand for rockets, missiles and ammunition. Mazagon Dock shipbuilders and Garden Reach shipbuilders and engineers benefit as naval platforms increasingly incorporate advanced combat management systems, sensors and electronic warfare suites. Now let's move to energy and power. Energy and power form another critical pillar even though allocations are spread across ministries. The most important quantified measure here is the 20,000 crore allocation for carbon capture, utilization and storage, which is designed to reduce emissions from existing thermal power plants rather than shutting them down. Carbon capture simply means trapping emissions before they enter the atmosphere. This approach allows existing assets to remain productive while meeting environmental goals. Alongside this, the budget extends basic customs duty exemptions on capital goods for nuclear power projects until 2035, and this exemption now applies to all nuclear plants regardless of capacity. On the clean energy side, customs duty exemptions continue for capital goods used in lithium-ion cell manufacturing, which supports battery energy storage. Battery storage is critical because it allows renewable power to be stored and used later. The exemption of sodium antimonate for solar glass manufacturing further reduces input costs for solar projects. Additionally, when biogas is blended with CNG, the entire value of biogas is exempt from excise duty, improving project economics. These measures support power producers and financiers. NTPC benefits because it operates across thermal, renewable and nuclear segments and can adopt carbon capture technology. Tata Power benefits from renewable generation, battery storage and power distribution. JSW Energy aligns with the clean energy transition supported by duty exemptions. Financing of these projects flows to REC and PFC as higher power capex directly increases lending opportunities. Another important structural shift in this budget is the focused push towards rare earth materials, which are essential for electric vehicles, renewable energy equipment, electronics, and defense systems. The budget announces a dedicated initiative spanning research, mining, processing, and manufacturing of rare earth permanent magnets, indicating that the government wants to build an end-to-end domestic ecosystem rather than remain dependent on imports. Rare earth magnets are a critical input for EV motors, wind turbines, precision electronics, and advanced defense systems. By announcing dedicated rare earth corridors across states such as Odisha, Tamil Nadu, Andhra Pradesh, and Kerala, the budget signals a clear intent to strengthen domestic research, mining, and processing capabilities. This moves rare earths into the category of strategic long-term supply security rather than a cyclical or commodity-driven theme, especially as India looks to reduce dependence on imports for these critical minerals. From a listed market perspective, IREL stands out as the most direct beneficiary given its role in rare earth mining and processing under government ownership. NMDC benefits indirectly through its exposure to strategic mineral development and mining capabilities. On the downstream side, companies involved in advanced materials and manufacturing such as Tata Steel and Hindalco benefit as demand for specialized alloys and high-performance materials increases alongside rare earth processing and magnet manufacturing. One of the most important shifts in this budget is the clear acceleration towards technology-led manufacturing. Budget FY27 formally approves the second semiconductor scheme and significantly scales up support for electronics with incentives increased to 40,000 crore. This is a decisive policy signal that the government is doubling down on building a domestic electronics and semiconductor supply chain. The focus is not limited to chip fabrication alone, but extends to components, electronic manufacturing, and the digital infrastructure required to support this ecosystem. This allocation growth aligns with the expansion of the India Semiconductor Mission to ISM 2.0 and the launch of the Electronics Components Manufacturing Scheme. On the cost side, the budget removes basic customs duty on parts used in microwave ovens, components used in aircraft manufacturing, and raw materials used for defense aircraft maintenance. Customs duty is a tax on imports, so removing it directly reduces costs and improves competitiveness for domestic manufacturers. Now, deferred duty payments for trusted manufacturers improves working capital by allowing companies to pay duties later. These measures benefit electronics manufacturers such as Dixon Technologies, which operates at scale across consumer electronics. Kaynes Technology benefits from industrial and automotive electronics exposure. Amber Enterprises benefits from component manufacturing. Tata Elxsi benefits as advanced manufacturing increases demand for product design and embedded software. One of the most consequential announcements in the budget is a tax holiday until 2047 for foreign companies providing cloud services through India-based data centers. Now, a tax holiday means these companies pay little or no tax for a long period, which is essential for capital-intensive investments like data centers. In addition, data center service entities are granted a safe harbor margin of 15%, which simplifies taxation by allowing profits to be declared at a fixed margin. For IT services, the safe harbor threshold has been raised from 300 crore to 2,000 crore and the margin fixed at 15.5% with automated approvals. Now, safe harbor is a simplified tax framework that reduces disputes and uncertainty. These changes improve predictability for IT companies. This supports companies such as NetWeb Technologies, which supplies data center and high-performance computing infrastructure. Large IT services companies such as TCS and Infosys benefit from stable tax treatment and margin visibility. Now, let's move on to healthcare. which also shows steady allocation growth. Health and family welfare receives an allocation of 1.04 lakh crore. This supports public healthcare infrastructure and services. Policy measures include exemption of 17 cancer drugs from basic customs duty, which reduces treatment costs, and the launch of Biopharma Shakti, which focuses on strengthening biopharmaceutical manufacturing and testing infrastructure. The budget also proposes 5 medical value tourism hubs, encouraging high-value healthcare services. This benefits pharmaceutical companies such as Sun Pharma, Biocon, and Dr. Reddy's. Hospital operators such as Apollo Hospitals and Max Healthcare benefit as organized healthcare and medical tourism expand. Now let's move on to agriculture. Agriculture and allied activities receive an allocation of 1.62 lakh crore, supporting farming, allied sectors, and rural livelihood infrastructure with a focus on productivity and value creation. This is focused more on productivity and fisheries rather than subsidies. Fish caught by Indian vessels in the EEZ or high seas is now duty-free, and the budget supports development of 500 reservoirs and Amrit Sarovars, improving water availability. This benefits companies such as Avanti Feeds, Godrej Agrovet, Coromandel International, Chambal Fertilizers and Chemicals, UPL and PI Industries. Additional direct beneficiaries include Gujarat State Fertilizers and Chemicals, Paradeep Phosphates, Deepak Fertilizers and Petrochemicals, and Tata Chemicals through higher nutrient application and crop intensity. Crop protection and seeds linked demand supports Bayer Crop Science India and Rallis India, while aquaculture activity continues to directly benefit Apex Frozen Foods alongside feed suppliers. Now, when you step back and connect these allocation changes, Budget 2026-27 clearly prioritizes asset creation, defense, technology, and logistics, supported by a 9.8% increase in total capex. For investors, the signal lies not in one announcement or one stock, but in following where allocation growth and policy support move together over multiple years. That brings us to the end of this analysis. We've focused on the sectors where budget allocations, policy intent, and execution visibility align, because that is where long-term opportunities tend to emerge. If you have a different view on any sector or stock, share it in the comments, and thanks for watching. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.